You can't invest. You're not smart enough. You don't have enough money. The process is too complicated and we don't have time to explain it to you. The market is for people with big money. When you have big money, come back and see us. Take the $1,000 you have, put it in a CD. That's the voice of old Wall Street. And this is the Silver Reports in Focus, where we take a look at companies or markets that made Wall Street's news cycle. This week we bring Robinhood in focus. That intro, that's how regular people with small amounts of money used to be greeted by much of Wall Street in the 80s and 90s. Merrill Lynch, when they were kings of the street, didn't make time to work with a young investor with $1,000 to invest. But luckily for small investors everywhere, discount brokers established themselves as reliable places where the public could invest their money. Although discount brokerages provided a better option to the full-service houses for your average 9-to-5er, it wasn't a great option. There were still minimum deposits you had to come up with, which could be thousands of dollars. There were nagging maintenance fees that discount brokers charged for holding investors' money, and there were inactivity fees. That was a thing too. If you didn't have money to trade once a month, you'd be hit with an inactivity fee. Then there were the commission fees on top of it. It was a tough go for the average guy or girl to get invested in the markets. In 2014, though, we get Robinhood, an upstart brokerage. It enters the investment space and it's commission-free with no minimum deposit required. Old Wall Street's reaction to Robinhood wasn't hostile as some would expect. Wall Street did a shoulder shrug and continued doing big business as usual. Robinhood would become an investment tool that catered to a customer that traditional Wall Street didn't care much about. The charts, one with traditional full-service brokers and the other with discount brokers, displays increases in market values for traditional and discount brokers since Robinhood hit the App Store. Robinhood a disruptor? Yes, but a threat? Not really. Even last week's announcements of commission-free trades by Schwab, TD Ameritrade, and E-Trade seemed at first to be motivated by Robinhood. But after further investigation, these particular firms have been cutting fees for years. Remember the inactivity fee and maintenance fees I discussed? They've been gone for some time now. E-Trade used to charge a $9.99 commission per trade. They've trimmed that down to $6.95 per trade, or $4.95 for very active traders. Although discount brokers had been racing to cut fees before Robinhood, I'd have to attribute some of the zero commission moves to Robinhood. In May 2018, Robinhood had surpassed E-Trade in the number of customer accounts, and that was a big deal for the young company. Robinhood had hit 4 million user accounts in 4 years. E-Trade had 3.7 million accounts and had been in business for over 30 years. Robinhood did admit at the time that not all 4 million accounts were funded. In addition to that, Robinhood didn't and doesn't release its assets under management. Whether it's firm to firm or individual broker to individual broker, it's all about what you have under management, what's in your book. With Robinhood admitting that not all 4 million accounts were funded and a refusal to reveal the amount of money it has under management, Wall Street shrugged its shoulders again and continued doing big business as usual, not seeing Robinhood as a threat. Robinhood has been seen as a disruptor, but it's difficult to find what it's disrupted. Yes, it's provided a way for millions of people to invest. A portion of those people, however, weren't being coveted by major Wall Street firms. Goldman Sachs has no place for the young or old investor who wants to build a position in Apple one share at a time. Doing so through TD Ameritrade and E-Trade would feel like a death by 1,000 cuts, as commissions paid for each transaction would eat into every dollar gained. The thought of traditional Wall Street being concerned about Robinhood's entry into the investment market has always been overstated to me. Now, though, Robinhood has to worry about Wall Street infringing on their turf with zero commissions trading. Robinhood's next step, not counting the potential savings and checkings account aspect of their business, will likely be information. Information is what their competitors offer that they don't. Schwab, TD Ameritrade, E-Trade with zero commissions for stock trades are a tremendous value for investors with all the information those platforms offer. Robinhood was able to gain popularity by knocking down the barrier that stood between regular people and the world of Wall Street investing, and all it took was a basic app and commission-free trading. But what does Robinhood do next? The investors that no one wanted, the investors that Robinhood invited in and provided investment experience to, are now wanted by Schwab, Ameritrade, and E-Trade. Personally, I think the move to zero commissions is a win for the general public. People and VCs who have invested in Robinhood may think differently, but I'm a believer that the stock market is a simple way to change a person's financial situation over the long term. Yet so many people go through life without learning how to access it. Add to that, the people with the information of how the market works aren't very eager to pass that information on to a complete stranger. And that leads to a large number of people sitting on the sidelines while billions of dollars are being made. Competition is great for consumers. Pressure has been applied to Robinhood by the major discount brokers, but I don't see Robinhood going anywhere. Robinhood's app and website are very basic, but with a few more features and better information to help new investors along, they could continue to grow in spite of what the other discount brokers are doing. The ball's in Robinhood's court. The Disruptor, the company that took the investment industry by storm, is being stormed by the investment industry. How will they respond?